Hey everybody, this is Morris from San Jose Options. You can find us at sjoptions.com. Recently I received an email from an option trader and they were very curious about this SPX weekly credit spread. And there was a study by the financial network Tasty Trade, and they did a study from 2010 to 2015 on this weekly trade where they sold approximately a 20 delta on the put side and used a 100-point wide credit spread. And what you have is similar to what we're looking at right here. So the first thing we notice with this strategy is that it's very bullish, and if you're right, then in this case you can make approximately 8% on the one trade. But if the market happens to move down this way, just a small move during the week, then you'll experience a tremendous loss. Now also in their study they compared putting this trade on every single week with $10,000 to putting $10,000 one time into a mutual fund. I wanted to clarify something because in their study they stated that they were comparing apples to apples. However, if you think about it, they weren't actually making the fair comparison, because this strategy requiring $10,000 at risk per week over a 5-year period theoretically is actually risking $600,000, where if you allocated $10,000 to a mutual fund, you're actually only risking $10,000. So it's very important to clarify that. And you'll see in this discussion right here that this trade over the last 6 months has lost much more than $10,000. It's essentially a deep pocket trading style that they described, because if you lose, you have to keep replenishing the account with a new $10,000. So next we'll look at the price chart, and I'll just point out some of the things that have happened over the last 6 months. Okay, so here I've brought in the price chart of SPX over the last 6 months, again to study the performance of this strategy. So over here in August of 2015, we had a pretty fast drop in the market. If you had put on this weekly credit spread right in this area, and then coming down here, the trade actually lost about 90%. So again, with the $10,000 allocated, that was about a $9,000 loss. From here to here, very interesting, because I looked at the dates, and luckily this one stopped right here and started right here. So this one, again, very fortunately worked out. But if it had fallen on this date, then again it would have had another tremendous loss, like 30 or 40%. So this one was just pure luck that the trade did not lose an awful lot. Over here, the trade lost around 41 to 45%. This week here it lost another 40%. And then in this week here, we just finished, and it would have lost 80%. So just in the last 6 months here, the trade lost over 250% on those 4 losing trades. And then if you count all the winning trades, it made possibly about $8,000. So the total loss for the last 6 months would be approximately $16,000 to $17,000, which would be a overall loss of about 160 to 170% of losses, and that's after you count all the winners. So as you can see, it's not the same as investing $10,000 into a mutual fund. The fund certainly could not lose over 100%. So it's a deep pocket strategy. It's very different than investing $10,000 to mutual funds. So it's not an apple to apple comparison. It's very different. So the bottom line here is that it's a neutral to bullish strategy. Any quick move in a bearish market, and this strategy will sustain pretty large losses. So again, the performance of the last 6 months, it's lost around 160 to 170%. So beware. And also just starting off, this year, as they say, it's the worst beginning we've seen, or the most bearish. It doesn't have to be bad if you know how to trade a bearish market, but it's the most bearish market we've seen in the stock market history. So this is certainly not a strategy that you'll want to be using this year. Doesn't look like a good one. So thank you very much, everybody, for watching this video. Hope you picked up just a few trading tips. And as always, best of luck with your trading. And once again, Happy New Year. Good luck in 2016.